but it's getting there. All right, and then the mortgage payment, because of the mortgage rates, if you qualify, okay, here's the mortgage payment for the median mortgage payment on a median priced home in the South Bay is now down to about, well, we figured it out, about $2,000, $2,100. And it's the lowest it's been since 2003. So 6 years of, non-affordability has been wiped out. That's where we are. Here, the final words. The issue of affordability, high affordability, job losses are abating, easing in credit, that's going to support the demand this year. We're going to see a much better spring. On the issue of credit, stabilizing home values are a clear sign that homeowner distress is diminishing. That's going to encourage lenders to loosen credit standards. That's what we need to wait for. The clear decline in foreclosures, no threat, and job creation and housing prices going higher. And you're going to see credit conditions start to loosen up. They're certainly not going to go to where they were, but they're way overkill. Okay, last thing on foreclosure update. Defaults decline at the end of the year. Here's homeowner distress in Southern California, NODs, there's foreclosures. NODs peaked, foreclosures peaked subsequently to that. NODs then peaked again, no peak in foreclosures. They didn't. There were more workouts, modifications, moratoriums, whatever the case may be. We haven't seen that foreclosure surge. All right? But yeah, we've been warned about it over and over and over again. So it still may be coming. I'm not going to say that it won't. But we don't think it's going to cause a problem. It didn't in California in the fourth quarter. There it is. It really didn't surge. We expected it to. Okay, here's my final comments. Labor market hasn't recovered, but will improve by the end of the year. Housing affordability has improved. It will remain affordable throughout 2010, but we do worry about the mortgage rate risk once the Fed starts to reload the federal funds rate, raise rates as the economic recovery becomes much more evident. All right, credit markets will gradually improve over time. Home prices will firm as home prices firm and foreclosures clearly diminish. So my outlook is 2 to 4 more months of contraction. The retail fallout is going to continue. Office industrial markets will recover, but probably not noticeably till the end of the year, beginning in 2011. Home sales, look for a better spring and summer. Because as this negative sentiment diminishes, and it has been, among the general public about the recovery and the prospects for it, you'll see people step up and buy. Prices are too low, affordability is too great right now. That's what's going to drive the housing market. Okay? Housing prices are past their bottom. More new housing we'll see in the second quarter of 2010 will look much better than 2009. All right? In fact, the imbalances that we've created during the Great Recession actually argue for a much stronger recovery in 2011 than people are assuming. Okay? Thank you.
Is this a good time to buy a house?
Yeah, this is today.
Yeah, I brought extra business cards. If you guys need help with that. I don't know why I'm putting this on. I'm going to introduce Kyle Ransford here. He's got an extensive background in financial analysis. He's done a lot of investments with Cardinal Investments. Don't know where that came from, but he's also one of the founders of the Bank of Manhattan, and you're also the executive chairman of the Bank of Manhattan. And you're going to, part of the missing piece here is with, it's a good time to buy houses and property, but we need loans in order to do that. So you're going to help us with that piece of the puzzle, right?
Absolutely.
All right, come on over here and tell us how to do that. Good luck with the microphone.
Thanks. How are we doing that? Is that good?
That's good.
Yeah. Okay. So I'm going to try to take the conversation a little bit and drive it into the mortgage industry, what has happened there, and what the outlook is for the future, and give you a little example what changes are happening here locally, specific what we're doing and other community banks are doing to change how the landscape of that field works. So first, just a quick background. Bank of Manhattan, we were formed opened in August of 2007 during the Great Credit Crunch. It's better to be lucky than good sometimes. We basically opened after the period when people were making funding loans into areas that, as the credit crunch came on, became problems. So we've had the opportunity to have a very clean balance sheet, no problem assets, and moving forward. We just recently crossed the barrier of lending $100 million into the local community, and we're able to do that. Banking is fairly simple. People come in and bring deposits in the form of checking accounts and CDs, and the bank is able to lend that money back out into the local community, and the depositors are able to get insurance from the federal government that they'll get their money back. So the depositors and the people in the community are what allow us to redeploy the money and lend money back out into the community, and you're seeing that happen, throughout the country. Our primary piece, is a high service experience in banking. Then we do business banking, real estate lending for commercial real estate, mortgage lending very soon. We've been working on this for quite some time. We'll get a little bit more into some of the reasons and what happens in markets as these markets recover, but we expect to be mortgage lending very soon, and then wealth management in the future. So let me push this forward and see if I got the technology right. So there's a little bit of an overview of where we're going, but let me give a little bit of a background to make sure everyone has some context for the way that the mortgage industry used to work, so we can talk about what's happened to it and how it might work in the future. It used to work, there was lots of, quote, mortgage companies and banks that would make individual loans to individual buyers and refinance candidates. Those loans would then be consolidated, and capital markets groups would turn those into bonds, and then end investors would buy those bonds. And then things like our 401k that has mortgage little fund would would fund that. So you would see it go from one mortgage put into a pool of tens of thousands of mortgages that then someone is buying a piece of that probably rolls back to somebody's retirement plan or individual purchasing plan. And what happened is, as the credit crunch came on and the foreclosure rates increased, as you saw in sort of the red dots, all of a sudden everyone said, oh, wait a second, these bonds that we're buying, that we're basically buying all these underlying mortgages, they're all going bad, we have no idea what they're worth, we don't want to buy any more. And so that created a problem. If a bank or a mortgage company wanted to go make a loan, there's nobody to buy it because there's nobody to buy the bond. And so the whole market froze. And that's when we saw the government step in. Without moving the conversation into politics, but it's hard to talk about government without talking about politics. Our economists and our view is that the government intervention has been very necessary and on the whole very good. As with any large programs, you can find some places where you might not have done this and you might not have done that at the margin, but you saw the government step in through taking over Fannie and Freddie and the FHA and moving the mortgage rate up to 729, which helped a lot of that math. But not necessarily our community, because as you know, the housing prices in this community tend to be higher and not qualifying for that piece. But my experience with the market, and I would assume similar in the room, is if it's a transaction that is using a Fannie Freddie qualified loan of 729 and less, the money's there, it's easy, and it moves quick. The challenge is there's no jumbo market, and that's because the government didn't step in for the jumbo market. And did step in for the other piece, and that's really sort of stabilized and rebuilt that, rebuilt turning the reds into yellows and so forth, as you saw. So that giving you a little bit of context, we'll move through some details and then talk about how we see the market changing. Okay, this is different here. So
what do you want? I have.
You have. Okay, perfect. So I don't have to press. I press this and you press that. That works perfect. So here, what this slide shows very quickly is the Fed funds rate is the rate that banks can borrow from banks overnight, and mirrors reasonably well the cost of the money at a banking institution. And then the lines you see on top of it are 5-1 hybrids and 30-year ARMs, basically the cost of a mortgage. And you'll see, in the boom times from 05 to 08, the spread that was getting made from the difference between the cost in green and the income in the red and blue got very narrow. And that's